Good afternoon, everyone. I appreciate you taking the time to join us. Before we dive in, I'd like to briefly share how Penny Insurance supports agents in growing their life business. In our experience, life insurance opportunities rarely disappear because clients lack interest. More often, they stall due to administrative burden, paperwork, underwriting coordination, and ongoing follow-up that can stretch an agent thin. And that's why we built the Penny A-Team. The A-Team is our dedicated group of specialists who step in once you introduce the opportunity. From the initial client discussion through underwriting and policy delivery, they manage the process from beginning to end. And here's what it looks like. They conduct and support client conversations. They complete applications and required documentation. They coordinate underwriting and carrier communication. They monitor every case to ensure steady progress. So this allows you to focus on what you do best, building relationships, advising clients, and generating new opportunities instead of tracking paperwork and status updates. Keep in mind, it's not outsourcing. It's a true extension of your practice, supported by structured systems designed to keep cases organized, compliant, and moving efficiently. And the outcome is straightforward. More policies placed, more time in your schedule, and a better overall experience for your clients. And with that, I'll turn it over to Charles. Welcome, Charles.
Hey, good afternoon, everybody. Today we're going to go through some simple explanations on business protection, some exit planning, and how to use life insurance within a corporate structure to protect business and partners. I'll get our slide up here shared. And then we'll open up for some questions at the end of the presentation. Will everybody see that? Might have someone to give me a thumbs up if you can see the presentation.
Giving you a thumbs up.
Excellent, thank you. So guys, I'm your advanced case design specialist, kind of your back office support here at Penny. What we do is we've added on a couple of new features and new arms to be able to help you guys kind of not only conceptually structure cases, but offer some more premium services within your client base. And today we're going to go over a couple basics such as COLI and Key Man. Be fairly quick and to the point. And then after we kind of get through the slideshow, we'll go ahead and kind of open up for a few questions as time is allotted. So appreciate you bearing with us. So today's presentation, business protection and exit planning with life insurance. Life insurance, not just for families. Business use life insurance to protect owners, employees, and the continuity of the business. And this presentation is going to explain a couple common strategies, just a few that were kind of handpicked out in fairly simple terms. Typically what happens, any business owner, you're going to see that, at some point, either life or business is going to throw you a couple curveballs. And sometimes the continuity of your business is almost completely contingent on the planning that you put in place in case something goes wrong. Some of these simple strategies are a way to keep a business operating or provide it more time and liquidity for business operations in case that a catastrophic thing happens. Maybe you lose a key employee, or an owner dies or something like that. It also provides an added factor of being able to add that on the balance sheet for the business as far as valuation goes as well. So without further ado, kind of move on. So why use business life insurance? Well, it will protect the company if an owner or a key person dies. What happens often is if you have kind of the star of your business, a star salesperson, owner, or your key operations person either leaves or passes away, often the business is left in flux, and it's possible for them to lose revenues going through that transition. What happens is if they are covered with corporate-owned life insurance, it provides immediate liquidity and extra tax-free cash so that they're able to get in there and either find a replacement or be able to take on the training costs to get new staff trained up, or let's say a major partner passes away, it provides the liquidity that that partner would usually have to support that business as the decedent is kind of their estate's moving on. So it will provide cash when it's needed most. And a lot of what happens, great business owners, you can put two great business owners side by side. And if something happens that causes a major flux within the business, often the key variable that's going to keep that business in its continuity, keep it running, is an injection of liquid cash at a time when it's most needed, especially when demands have not stopped for the business, but the key employee that handles those demands is no longer present. So it provides cash when it's needed most and helps that business run without or with little disruption, as kind of as allotted, and supports long-term planning as well as exits for partners that are maybe looking to at some point either sell or have their part of the partnership equity covered, so that if they pass away or leave, it will be able to provide liquidity for the other partner to buy out their section of the business. And simply, it kind of runs like this. As a corporate-owned life insurance, it's going to be used for protection. It can also be used for key benefits. I've also seen corporate-owned life insurance used as a defined benefits program, or even cash value life insurance is kind of used as golden handcuffs for a key employee, where if they do a period of term of years for the company, they will eventually be gifted that in the form of a kind of a key man policy as well. That life insurance is usually owned by the business, or it is owned by the partners of the business, and what they call a cross-sell key man, where one owner owns a life insurance policy on the other owner, and vice versa. And if either one is kind of pulled out by circumstance or passing away, what happens is that other policy goes into effect and provides the liquidity to buy out that equity. So there's not a fire sale or a massive disruption to the business as the other owner is looking to pass on a legacy to their heirs or beneficiaries. The business, in some cases, many cases, will actually pay the premiums, and the business can also be the beneficiary. But in the case of cross-sell key man, it would actually be the individual partners. And then also with other key man policies, the policy can be gifted to an employee. So it's not always owned by the business, but in many factors, it is. Moving on. And simple explanation of how it works, probably a little redundant by this point. The death benefit would be paid to the company. The company buys a policy on an executive, or a company will pay the premiums, and that policy builds cash value over time. That cash value can be added to the balance sheet of the business if it's corporate owned, or the cash value can be used as a defined benefit or a control feature, keeping key employees in place and incentivizing them for their many years of loyalty. So there's more than one way it can be owned, but typically we do put it under the structure of corporate owned. Typically, why do companies use COLI? Well, we've kind of talked about it ad nauseum of supporting the business operations with injections of liquidity during probably times that are not ideal, but also it helps offset benefit costs. It provides tax advantage, cash value growth, and it creates a financial asset on the balance sheet that can be added to the valuation. And it can also be used to help fund long-term obligations, or can be loaned against for tax-free cash for either mergers, acquisitions, or longer-term acquisitions that they'll need for business, such as warehousing, PP&E, property, plant, and equipment, et cetera, et cetera. And what is key person or key man insurance? Typically, and this is another flavor, corporate structured life insurance. It's insurance that's on that critical employer owner. If the company suffers financially, if they pass away or something's interrupted, once again, that policy is going to be there to help, provide liquidity for training new employees, getting the talent they need to come in and replace the decedent or the person that was lost that was crucial to the business, and helping support business operations and continuity. The insurance provides that cash, giving them ability to recover. And what happens is if a business owner, let's say a small partnership, does not have this in place, all of that liquidity that would have to be provided, if it's not already there in earnings or not already there held in cash on the balance sheet, it's usually going to come out of the owner's pocket. And in the case of partnerships, often those partnership residuals are going to end up having to get paid out for the other partner to have control over the business. If not, what will happen is either a spouse or family or children, that portion of the equity would go to the other partner, the decedent partner's estate, and they would be looking for either to exchange their shares or take part actively in the business. Sometimes that can be a good thing. Sometimes it can be very inconvenient for the other founding partner to take on new people that haven't really been in the business, and can be somewhat problematic. And this causes a little bit of a guardrail that keeps that from happening. It's very common for small and mid-sized businesses that don't have millions and millions in retained earnings, and they need to make sure that there's a business continuity plan. Another great thing, when we're talking about key person insurance examples, if an owner or top salesperson passes away, that business is immediately going to see lost revenue and leadership. That insurance payout, as we said, kind of ad nauseum already, is going to cover hiring, training, lost income, any other acquisition costs to get them kind of back into the black and get them operating. And it gives the business time to adjust. Moving further on, and so another section of this would be the buy-sell agreement. And what is a buy-sell agreement? It's a legal agreement between two business owners or more. It explains what happens if an owner dies, retires, or exits, and creates a continuity plan for that business. It prevents disputes between partners or partners' families, and is often funded very simply with life insurance. Now, if they just need the buy-sell agreement, often they can do a high-level term. There are some semblances where they would rather use a permanent or cash value policy because they're able to keep that kind of cash on the books as an asset for business valuation purposes. So it is fairly variable. You have options to use. You don't have to use a whole life. You don't have to use an IUL. There are many considerations where small businesses would just use a blanket term that would kind of take care of everything for them. As far as the buy-sell agreement, kind of expanding on that, when those two partners or more own a business, one partner passes away, that life insurance provides the cash buyout to the family so the original owner can keep control of the business. It's a lot of it has to do with keeping control and being able to manage the business in those times when they're in a deficit of a working partner. And why fund buy-sell agreements with life insurance? Well, there's two reasons. One, for the reasons we stated, but also if they have the immediate cash at the exact time when it's needed, that's going to cause, it'll stave off some problems. But also, let's say the business is seeking a little extra liquidity for expansion. They can even borrow from the cash value of those policies as partners signing off on it to expand, like I said, property, plant, equipment, hire more staff, or generally do things that would require expansion for the business that would be otherwise paid and taken from the retained profits. It will keep the business stable in that instance, and the fair value is paid to the departing owner of the family. So the original owner won't really have to spit out the cash themselves to buy out. It really provides balance sheet control for the living partner that's left with the responsibility of business continuity and running that business. So diving in a little further, what is exit planning? Exit planning, how is an owner going to leave the business? Would it be at a retirement, sale, or death? It really focuses on maximizing the value and a smooth transition. And life insurance is often a key part of the solution once again. For key employees or for a business owner that's leaving, they can either be gifted with a defined benefit program from a life insurance retirement plan, where it's kind of an exit gift, or they can use that cash value to be able to sell a portion or buy a portion of the other person's equity and change up their equity holdings. There's it's variable. There's a lot of different moving parts to it, and it can be used in a lot of different ways to support the business as well as the partners. Moving forward, and once again, ad nauseum, it's providing liquidity for buyouts or events. It can equalize the inheritances between children that are beneficiaries of that owner, and whether that owner's is a decedent, or if they have cash value left and want to be able to distribute that over to owners, or even if they want to place the next generation in that business as a partner, and it provides for a little bit of leverage for some startup capital for that person to get acclimated and have some free cash flow to make sure that the business is running smoothly in a time that we might be a little bit tumultuous through that transition. It can also create income or legacy for those owners, like we're talking with defined benefit contribution plans or defined benefit plans. And it really reduces the financial stress during that transition, so everybody can focus on business operations instead of where they're going to get the next dollar to keep the lights on as they're going through that period. Moving forward, kind of putting it all together, 4 simple formats for this. The first one, company level financial planning tool in the form of corporate owned life insurance, where the business specifically owns it. This can be used also. It can cross up against key man as well. It can also cross up against split dollar arrangements, partial split dollar arrangements. There's about 3 or 4 subsections of different flavors that would fall underneath that. And then key person, obviously, which protects against the loss of critical people. With that, either creating a defined benefit plan or providing a gift of cash value to loyal employees as they're, kind of rising up the ranks, and knowing that if they stay for the term of contract and do the things they've agreed to do, that they will be gifted a little bit of extra, either equity or compensation. That's a really big thing with Key Man. As we kind of already went over, buy sell ensures ownership continuity, and then finally exit planning, aligning with those business and personal goals to keep owners with a path to eventually leave a succession plan and be able to leave the business and kind of turn it over to the next generation while they're able to take their retirement, buy out their equity, and shift into a period of retirement after they've given many loyal years to a business. So moving forward to the next slide, life insurance is a planning tool. It's not just protection. This stuff needs to typically be structured by not only the partners, but it'd be good to talk to your CPA. If you are doing something more complex, you might want to bring in a legal advocate or a legal specialist like an attorney, and then also either a corporate consultant or a financial advisor to show you how it structures, where the benefit is, and where the value added, and then in turn setting that protection up in a way that's both economical but also adds to the balance sheet of the business. and each strategy can solve a specific business risk. It's really, you'll weight against the four ones we've kind of talked, but there are many different subsets inside of those four different types of business insurance. It's most effective when coordinated with legal and tax advisors, which I just said. And typically, you want to look at the examples as illustrative. These are not guarantees. Anything can happen. Typically, what we're trying to do is put a contingency plan in place because, as a business owner, as you know, things will happen. Life is going to throw you curveballs. Your business is going to throw you curveballs, and then systematic and market and business risk can also come into play as well as economic factors. So it's something that kind of creates a hedge and is a great way to add some strength to your balance sheet while providing you a continuity plan. And that's kind of the long and short of it. I know it was a fairly short presentation, but we'll open up for a couple questions. I will kind of give you a little bit of a disclosure there. I'm not going to offer any individual business or advice. If you have questions about how it works, absolutely. But without looking over your P&L, without looking over your assets, liabilities, I am not giving any specific advice. This is all very general in education in nature. But if you have questions about the format and how it's used, I'd be happy to answer those questions or do the very best I can.
Thanks, Charles. So we have a few questions in the chat. So the first question is, what types of businesses tend to be the best initial prospects for COLI conversations?
Honestly, small to medium-sized businesses. Like when you have a good business, it could be tile shops, it could be anything. Even, I see doctors' practices, FLPs for real estate, attorneys' offices do this stuff. You're really looking for a business that does at least 550 to K to about $1 million in revenue, and they have a limited amount of partners. Maybe they have 15 employees. Businesses like that are completely contingent on the talent and the expertise of their employees. They cannot afford to lose good employees. They make great prospecting targets for this. And you're really looking those small, prolific businesses and medium-sized businesses that have an almost irreplaceable executive suite. Those are your hot spots. You don't want to go trying to target small cap companies with 500 employees. They have millions in retained earnings. They don't need a continuity plan with this. They usually have shares of equity, and they have other ability to issue their own cash in a way of as a form of like either issuing bonds or issuing stocks, or even handing out for key people RSUs, restricted stock units. So this is really perfect for small and medium business owners.
Okay, and we have another question that came in. What does COLI solve most effectively?
COLI actually would solve a multitude of issues when structured correctly. But having said that, there has to be a little bit of a reason there. So corporate-owned life insurance, let's say a corporate, I'll give you an example, great one. One of the flavors of corporate life insurance is BOLI, or bank-owned life insurance is a great example. And often what a bank will do, if they've got somebody, a big real estate, client that has a bunch of mortgages and, they may be able to pay it off with their estate, not really the concern. Those banks do not want to hold debt on their balance sheet that's not covered by something. So if one of their best clients passes away, and they have mortgage protection on that client, what will happen is all those mortgages get paid off and the bank stays in the black. Or even more, where BOLI is used as a key man tool, where you bring in bank executives that, maybe they're the hot shot guy you got from, Bank of America, and you want to incentivize them to come over your credit union and do what they do. Well, you say, hey, look, we bought bank-owned life insurance on you. If you do a term of 5 to 10 years, you do good work, you track your numbers, we're eventually going to either enter into a split dollar arrangement, or we're going to gift you that policy of which you could use the cash value as kind of a defined benefit plan. And it kind of spires out from there. There is a multitude of ways that you can use corporate-owned life insurance as either an incentive, a balance sheet boost, or a protectionary measure to keep your business in the black.
We have one last question that came in. Are you using it for NQ deferred comp and CERT plans? And I'm just going to give the there was a follow-up to what carriers and what's the underwriting? So kind of like a three-part question.
So typically what happens with that is if you're going to use it as a defined benefit plan, you're going to have to take a business census. You're going to have to put almost all of your employees, they take a census, and they'll do some semblance of group underwriting for your typical and median employees. And then for your executives and key people, they will do individualized underwriting. The process is not terribly complicated, but typically they're going to look at the risk pool and kind of look for, on the median employees, they're looking for a few key things that they might, disqualify you on. I won't get into the total specifics, but typically it starts with a census where, an agent will go in there and find out how many employees are we covering? How much is the contributions going to be? Are they going to be typically just employer, or are they going to be split dollar arrangements? Is it going to be 50% funded by, the employees pre-tax or after tax, or 50% by it kind of spiders out from there. So there's no one way that it's done. I've seen it used in a myriad of different flavors and variations. What it solves effectively for a defined benefit plan is tax-free cash. Even if you're doing a 401k or an IRA, eventually, even if you grow that thing out, sooner or later, you're going to pull money out of it, after 59 and a half. And maybe you have tax bracket control, maybe you don't, but you'll get some income tax on that. Or let's say you get to 72 and you will be forced by the federal government, the IRS, to take equal and substantive, required minimum distributions, of which also will be subject to income tax. The great thing about the employee-owned or the employer plan insurance that's permanent is they have another pocket that they can pull cash out for retirement that's fully tax-free. It doesn't operate exactly like a Roth. It's not going to grow the same, but 3% return, stable return, and being able to pull out 100% cash free is a big incentive, because they can lower the amounts they pull from their other retirement accounts and really control their tax bracket in their distribution phase or in retirement. What else we got, guys?
That looks like all the questions. Any final thoughts? Also, a follow-up. How can they best contact you if they have any additional questions?
If you have any questions, I am happy to meet with you after this or whenever. I'll give you, if you have a pen and paper handy, I'll give you my cell phone number. It is 325-656-0024. Or you can reach me at cking@pennyinsurance.com. And I will, yeah, okay, cool. I'll put that in the message too, so you guys can see it. Don't everybody all call at once. And if there's any way that we can help, help structure, or at the end of the day, what we want to do is provide a resource, back office support, and case planning support, so that you can go back and be a hero to your client. I have no desire to run it all. I could do all the work in the background. I want to put those solutions in your hand, and then you take it back to your clients. It's your job to go in there and be the hero to them. All I'm going to do is do the front end work for you. We just want to provide that support for you and let you know that, hey, there's more expanding business arms that you can go out and squeeze, more dollars out of your book, and you can, add more value to your clients and be able to offer them more than just P&C and life insurance. Not that those aren't very important things that you probably need to start on the foundation of before you do stuff like this. But we do more than that, and there's extra support there for you, and we're happy to partner with you in any way that we can.
So thanks everyone for joining us today. This is part of our educational series. So every Thursday at 12 p.m. Pacific time, we're going to be doing a webinar, and it's going to be part, again, of our educational series. So thanks everyone for joining us, and thanks for the questions. Any closing remarks, Charles?
I want to thank all of you guys for joining us today. We're going to have some more exciting stuff coming up in the future, and we'll be running these episodes, I think, once every week. And we have some really exciting material coming up, so stay tuned.
So thanks for joining us, everyone. We'll see you next time. Take care.
Thanks, guys.